After general market close, and about 15 minutes since the futures shut down until 4:30, 5 o'clock, something like that.
Yeah.
The futures go to 15 past, or is it 30 past?
I think it's 30. I think.
Yeah.
I don't know for sure.
We don't do that. All right. Sorry about the screaming vortex of death. I thought we'd try something a little different here on Cheat Sheets today. Let's start with the basically I ran a data table on all of the major global asset class ETFs. So we can look at it. Boy, gold had a day.
It did.
Almost 4%. It was like 3.5%.
Yeah, 3.5. Yep.
So Jerome Powell basically told Trump and his team to stuff it, right? We're not going to be there to do anything.
Right.
Yeah. What was he gave a speech? Is that what was the context of his "we're not doing anything"?
I think he was at the Economics Club of Chicago today, if memory serves. But basically, in a nutshell, it was the data does not yet support us doing anything, and we will follow the data.
And they're worried about inflation and growth, but they don't know if they're dual mandate. Basically, they said they're in a box.
They said they're in a box, but he did say that their mandates, to paraphrase, their mandates will be, they expect them to be tested or to be tension between them, I guess is what he said.
Yep. So I think that, and then NVIDIA whined about profit margins getting whacked 30%. I don't remember all the details on that. Did you see that note today?
Yeah, where they're getting fined and their ability to sell certain chips abroad is
impacted by the GT.
Yeah.
So I think the most important ticker on our cheat sheet stack is TLT, because everything, really, our economy, our financial markets, the opportunity for contagion, how China and U.S. come out on whichever vanquishes the other in the trade war. It's all based on the long bond, right?
Agree.
The long bond, everything else.
Agree.
So this is a good chance for us to review the for those who are new to cheat sheets and to subscription. Basically we provide a data package for free on the global asset class ETFs and certain other subsector ETFs, and then for $5 a month, and I haven't raised the prices ever, you can get a little deeper dive and a little more data more often, and some stock picks too. But so TLT is that's the ETF, right? That controls the long. It's basically a reflection of the 10s and 30s. Is that my understanding correct?
Yeah, it tracks the long end of the curve.
Yeah. So when interest rates go higher, TLT goes lower, right?
Correct.
Yep. So a 32% composite tailwind score, that's a very bearish rating. Anything under 40 is very bearish. And the 10-factor pre-trade checklist that basically we weight and make each kind of contribute in a unique way to the total composite score. I guess that's the proprietary nature of this, because the technical indicators themselves are fairly well known. But it's the way we combine them that feeds the tailwind score. And so we start on the left. We have more lagging indicators, like the long-term trend is 10-week moving average above the 40-week. This is exponential moving average. So it's kind of like front-running the 50 and 200, right?
Yeah.
And then we have intermediate trend is the 10-40 daily. So when it's bearish, it means the 40 is below the 10. And when it's bullish, like it is in the short-term trend, so treasuries are rallying here. I'm looking at factor 3 now. We have a bullish rating. That simply means that the 10-hour moving average is above the 40-hour moving average. It's a very short-term indicator.
Are those? Do you also use exponential moving average?
Everything is exponential. It's the 10 and 40 exponential is the consistent unit of measure for these three trends. We just have weekly, daily, and hourly, factor 1, 2, and 3.
And just so everybody knows, exponential averages put more weight on the most recent data.
You got it. Right.
Yeah.
So it's basically, we try to lean everything here a little bit more forward because we're trend followers, right? We have exit strategies generally below a moving average or below a support level if we're bullish. And so the idea, sorry, my allergies are just killing me today. So the idea here is let's get into the trend trade early, knowing that every trade is risk managed, right? With 1% capital loss per trade, no more than 10% capital allocated to any one trade. So basic risk management rules.
Okay.
And we're only bullish really when the tailwind score is above 50 and preferably between 60 and 85. But what's important here, it's not about trading TLT. It's about looking at the metrics. So bearish lagging indicators, the moving averages, I would say factor 4 is the thing that keeps me up at night about US bonds in general. At least they're not very bearish anymore, which would be a Chaikin money flow under 0.2, which is institutions just puking at high volume. So we're bearish, which is Chaikin money flow between negative 0.1 and negative 0.2.
And that's buying pressure.
Yeah, buying pressure. We use money flow as the underlying metric for buying pressure.
Okay. Can I add a little color to that?
Yep.
Just
Please.
because I follow bonds pretty closely for my day job. You know, there's a lot of talk last week about the bonds sell-off being caused by something called the basis trade, which I'm sure there's some truth to that. But it, you know, as we've talked, every time we record one of these, you know, it's never one thing.
Yeah.
A byproduct of diminished trade is fewer dollars in foreigners' hands.
Yep.
Those foreigners then put those dollars into bonds. So there's going to be less buying pressure in bonds just as a result of less trade.
Capital is fleeing. The foreign capital is leaving the U.S. markets.
Absolutely.
And by basis trade, it's kind of a hedge fund thing where they buy treasuries in order to get leverage. We'll keep it simple.
Yeah, they buy an asset and short the same asset in the futures market.
Yeah. So basically, central banks have stopped long ago. You know, China, it's been more than a decade. They stopped buying treasury bonds, 10-year treasury notes, and Japan did too. Basically, they both hold some, but foreign central banks are no longer buying our debt, and so what's left? And the central bank, the U.S. central bank, is no longer buying debt, at least not at the moment. And because that's inflationary, when you have your own bank buying your own debt, you're not really doing anything to pay back the debt. You're just
expanding the money supply.
Yeah, you're diluting it, right?
Yeah.
So it's what creates inflation. That's why Jerome Powell was in no interest in helping the Trump team out with any kind of liquidity easing of any type. So that's so even though we're seeing now, we'll continue up with the factors, still lagging indicators here. Factors 5 and 6 basically look at relative strength against the IWV, which is the broad market. And so when you are outperforming a little bit, you get a neutral plus rating. When you're outperforming much more, you're bullish, and when you're really outperforming, very bullish. So the fact is, we've been seeing bond price performance relative to other assets be okay. The classic bear market playbook is you get defensive and you buy treasuries, and there's probably some money managers out there, like the one I met with today, doing that. But it's not confirmed. The relative strength is not confirmed by buying pressure.
Correct.
So, and then we move into what I think are, with buying pressure number 4, we move into some leading indicators that can really help you get a jump on things. So in an ideal world, you're looking for a tailwind score of above 50. And if you want to jump in early, you'd like to make sure there's a very bullish buying pressure. And then these next two are market forecast oscillators. Think of them, AA, like time frame specific RSIs, or relative strength indicators.
Mm-hmm. Okay.
So they're kind of a momentum measurement, but in specific time frames. Okay. So the long-term oscillator, whenever markets are pulling down, it's the very last thing to turn bullish. So we don't really worry about the long-term forecast being bear. In this case, it's ever so slightly bearish. The intermediate forecast is slightly bullish, meaning the market is forecasting that this short-term trend in treasuries might turn into an intermediate trend, but there's not a whole lot of buying pressure, not a whole lot of institutional conviction. So one headline and boom, they're gone. They're dumping treasuries, or somebody is.
Right.
Or China just, hints that they're going to drop treasuries. And since there's no institutional buying pressure, you're going to get a big drop and a spike in yields.
Yeah.
So it's a tenuous position. And then we have the near-term forecast and momentum oscillators. Those are things we like to use at the end of the trading day to confirm sort of a move from bullish to bearish or vice versa. So when we see very bullish readings in the near-term forecast, that's like for swing traders saying, yep, it looks like, price is moving toward the target. Doesn't say anything about the trend. And then momentum is like day traders. And, sometimes you'll see institutions piling into a stock or ETF at the very close of the market day. And so you'll get a very bullish 95 plus momentum reading. And that just says that, hey, there is so much action at a high volume going into the close that there's going to be follow through, or there's likely to be follow through.
And sometimes that's just people taking off or covering positional hedges, right? Or direct hedges. Yeah.
Yep. So really the 1 through 10, we explain those factors because some people have been trading enough like underlying combinations to confirm their green tailwind score when they're taking a bullish trade. So the only things that are bullish, and remember, we consider 50 to 60 to be mildly bullish, like a neutral plus rating. Whenever you see something in the 50s, you want to make sure that money flow or buying pressure is bullish. And the market forecast oscillator, at least factor 8, the intermediate market forecast, the one that's, our time frame saying, hey, the momentum means that the intermediate trend is more likely than not to continue over weeks to months.
Yeah.
And so we're seeing, foreign markets once again. This has been true really all year, hasn't it?
Yeah, and of course in earnest for the last 6 weeks or so, right?
Yeah. So EFA is basically a developed markets, right? I think the EFA is developed Western markets, but does not include the United States.
And that, to your point that you just made, that's capital fleeing the U.S.
Yep.
Yeah.
Yep. And VEU is a broader measure that includes. It's basically it's an all country index that includes every market cap weighted major country, not even minor country indexes worldwide, but not the U.S. And so VEU is just a tad under 50, but has some decent buying pressure, has some decent relative strength, has a bullish intermediate forecast, but is pulling back today. EFA and VEU, you see that heads up reading, the momentum reading almost got into that danger zone, but didn't quite make it. So we're probably looking at a potential bounce for this stuff, or there'll be follow through tomorrow and more downside. And so the only type of bond that anybody is buying right now, and once again, I just point out that even here, the conviction is pretty bearish. Look at that buying pressure on SHY.
Which is a shorter end of the curve, 1 to 3.
Yeah, these are like the ultra short, not ultra short as in leverage short, bearish directional. These are basically the uber short, under 5-year treasuries.
Yeah. Yeah.
And then, what I don't have on here would be there's a 1 to 3 month treasury. I don't think we have it on this particular snapshot, but we routinely provide that for subscribers. And finally, the one that just will not get out of its way, gold and now gold miners.
Right.
Although, let's not kid ourselves, GDX is either just getting started, but it looks like the one in charge is still gold.
Yeah. I wonder how much GDX's recent move is driven by the, quote unquote collapse in energy prices, right? Because mining is basically turning energy into gold.
And dollars down. So all of these are expressed in dollar terms. So what you're seeing is miners' margins will expand with the underlying cost of the precious metal they're pulling out of the ground and the cost to pull it out of the ground in energy terms, widening margins. And look at that explosive move from 40 to 51 in about 6 trading days.
Yeah.
Yeah. And so this one's behaving like this is more a commentary about the macro state of things.
Yep. There's some gaps on the charts that, as a technician, I notice and I'm aware of, but I agree with everything you're saying about gold.
Yep. AA has already passed his first of 3 chartered market technician tests. And so are you still studying for the second one, or are you taking a break before you do the next one?
No, I am. June is when I'm sitting for that one.
I know that costs a pretty penny, so I know you want to ace that.
Yeah.
All right, so I've got an old Fibonacci here, which I'm going to just get rid of because it's, well, actually, you know what? It's still sort of in play. So I'll leave it here, but we're not going to focus on it. I should mention that the let me actually get rid of the drawing because this is a good chance to explain our QuickView charts. This is something we provide every once in a while, especially when there's an interesting story. But the QuickView charts are a pictorial representation of parts of the cheat sheet data that we just showed you. So the background has to do with what we call long-term market sentiment. It would be factor 7. So the long-term market forecast, basically the months to maybe a year or more trajectory. And so whenever it turns green, it's saying that the odds are more favorable than not for a extended multi-month run in a in this product. And obviously that's happening, right? Gold. So when the background turns green, it's an extrapolation of the market sentiment oscillator, which is like an RSI for the longest time frame that we measure. We'll call it the investing time frame, the one that where you're in a trade potentially for months and enduring some intermediate pullbacks, right? So this is where you're using a longer term moving average as your support level. And then underneath that, you're going to see the 40-day moving average changing colors. And so there's 3 things that require the moving average to turn green from yellow or red. Yellow is just sort of a neutral rating. And sometimes you get a red, which means bearish. But when we see the foreground moving average turn green, it means that 3 things are true. Price is above a rising 40-day exponential moving average. Obviously, you're seeing that right now. It also means that money flow, Chaikin money flow, or buying pressure, is above 0.1. Okay, so it means bullish buying pressure. When it's that dark green color, it's bullish. When it's that light green color, it's very bullish. It's above 0.2. We call that the institutional FOMO buying pressure. And you can see today we got another burst of FOMO, right? Where you saw the 40-day EMA turn bright green, and we had a huge gap up higher. And then the third thing that has to be true is the intermediate market forecast oscillator for a green rating is must be bullish or very bullish.
Okay.
So when you have green, you know, it works a good 2/3 of the time. You know, it's a great little visual way to take a trade. A lot of times you can just take a trade and then you see that little dotted line underneath the 40-day moving average, the exponential moving average there.
Yeah, yeah.
So that's basically a 1.5, a volatility-based stop loss that you may or may not agree with, but it's just a guide to help you easily manage risk. So right now, it's probably not the greatest time to enter gold because it's gone absolutely terrible. I don't know about you, but if I were to enter gold, I think that you could see these pullbacks average about 7%. I think I'd have to set my stop, at around 270.
Okay. Yeah.
Yeah. I think it's hard to enter here. I guess you could maybe make the case for a support level, like here?
Yeah.
The bottom of that gap. I mean, it's very gappy, isn't it?
Yeah. I mean, even today's opening print, that gap, so.
But make no mistake, there is a big money panic into this asset class.
Right? And it's not new. This isn't a new development.
Oh God, you're right. And what is new is the volume. The volume has been great, but now it's almost 2x the average over the last 50 days.
But money has been flowing into gold for
almost 20 months now.
Yeah.
Yeah. So I'll show you the let's start with let me pull way out. Let's do a 5-year monthly chart. So yeah, this is when gold turned. Now these backgrounds mean less because we're on a monthly. The indicators were optimized for a intermediate daily time frame, not this. So I wouldn't pay too much attention to the color scheme here. But you can. There is one technique you could use to to project where this thing could end up. I guess I'm talking about, could we use this as a low and this is a high and kind of use a Fibonacci extension to predict price target?
Sure.
Or would you do it, because you're a technician, would you do it here or would you do it here?
I mean, I tend to do it from the low point.
Yeah, the low point, I would agree.
Yeah.
So here.
Yeah.
Yeah. So so this is one idea. And again, some other market technicians might have a problem with this, but the idea is you take from the low, you draw, oops. I'm going to do it from the wick.
Mm-hmm.
I think we agreed, right, that we both are into wicks.
That's right.
For some reason, my drawing isn't working. Let me just select it again. Fibonacci extension. And so from this low, we're going to draw up to this high.
I'm not getting it. There we go. Oh, there we go.
And then we're going to pull back. It's not the best color scheme for the video. Going to pull back here, and then these will extend. So you can see yesterday, it hit its first measured move target, 61.8 Fibonacci, and it nailed it precisely. And then it kept running today, but the price target I've got is 323-ish. If this move replicates.
Got it.
And you may agree, may disagree with it,
Yeah.
but I think it's a pretty good.
Yeah. And really the only reason I mentioned the fact that this has been an ongoing thing with gold is just to point out that it's not some knee-jerk reaction to policy moves. This move started long before our current predicament.
And most would say that this has not been U.S. buying. Now, it might be now. Yeah. But the U.S. buying, it's mostly been Eastern central banks.
Yeah. Certainly hasn't been retail U.S. buying, that's for sure.
Definitely not that. We don't know if the Treasury's been secretly buying.
Right.
But I think they might be now. There's actually rumors. Did you see there's rumors in the news about the U.S. accumulating gold before the great revaluation? I don't know if that's just one of those stacker paranoid, deep conspiracy theories. Or
who knows? But the Atlanta Fed said that their GDP Now tracker was affected last month by the sheer amount of the import of gold, which was throwing off their calculations and their models because there was so much gold imported in the month of February.
And actually that's 2 or 3 months in a row that's happened.
Yeah.
All right. So we so gold, even though gold is we thought it was going to slow down. I thought it was going to slow down last night because money flow, ticked a tiny bit lower, buying pressure again. But look at the volume now. It's just a panic. It's a panic into this asset. And the corollary of that, and again, we don't have the Dixie for some reason. I can't bring that up, but we'll use UUP. Here's the dollar collapsing. This is a monthly chart, by the way, and this is the month in progress. So goes the dollar, so goes gold. And what we're really showing you is less about an appreciation of the gold, because gold doesn't really do anything, right? There's no yield on gold. There's no earnings on gold. What it is it's a comparative money.
Store value, yeah.
Store value, yep. So what we're seeing is, so when you look and see an explosion in the price of gold when it's priced in dollars is basically a statement by how fast the buying power of our fiat currency is being diluted, which is something that our government wants to do because it's one way you make the debt cheaper, right? So when, a foreign investor who's loaned money at 0% interest rates and we have to roll that debt at 5% interest rates or 4% interest rates, the one way you can screw over the person who's been, giving you their capital is to devalue the dollar in terms of their currency and pay back the debt cheaper.
It's also an advantage for American companies in international trade, isn't it?
Yep. More exports if we weaken the dollar. And actually, that's the one thing that China and the U.S. have in common. They both would like a weaker dollar.
Yeah.
And so here is the weekly chart on the dollar. And again, we actually broke down, in my opinion, we broke down.
Oh, yeah.
Yep. So the dollar is you remember 2007 when Gazelle would not get paid, and she insisted she had to be paid in euros to do a modeling job?
I do.
I think, and there's 2000. Boy, God, we're getting old, huh?
Yeah.
There's the Gazelle.
Yeah,
This is the Gazelle.
I looked at that today. That was the low point in the US dollar. It was 70 on the DXY. I know we're looking at the UUP. But
Yeah, where you're looking at the UP. But I remember I remember on Fast Money, November 2007.
Yep.
There,
Yep.
that's the Gazelle's candle right there.
Mhm.
Monthly basis. All right. So we are dollar down, bonds down. I'm sorry, bonds up. Let's go to bonds next.
Bonds up. I think it's just a technical retrace.
Yeah,
it's a retracement.
It's nothing. But yields down, bonds up slightly. We showed you the lack of buying pressure. Oops. Sorry. GLT. There we go. Oops. Sorry. Something's going on with my computer here. Enter. There we go. So that's pretty scary, huh, on the monthlies.
Mm-hmm.
2020 was the end of fiat money printing without consequences.
Yep. The world changed.
Yeah. Our debt is now 50% less valuable than it was. And so anyone who thinks that bonds is going to save them in this bear market, I think is
I think they're going to be disappointed in the few years to come.
Going to be disappointed as soon as this breaks lower.
Yeah. I think by the end of this year we'll see a pretty meaningful move.
So I think we've pounded the table on this in cheat sheets, and I'm sure you have in your mortgage blog, Macro to Mortgage, right?
Yeah, thanks.
The fact is that anyone waiting for a cheaper loan, be waiting a long time.
The opportunity was on April 5th.
Yep.
When everybody was panicking into bonds before they realized that they had to panic out of bonds.
AA, there's one thing that you and I have seen repeat over and over and over again in the decade and a half we've been hosting videos, back when we were working with Mark Chaikin and helping him roll out Chaikin Analytics. You see it here. You know what I'm talking about.
The
failed
breakout. Well, I was going to point out the flag, but also the failed breakout.
Right. So we have a continuation pattern here called a wedge, flag, triangle, whatever you want to call it. And so we had what we thought was a bullish breakout. So did everybody. This was back in March, April. It was, I think it was just before Liberation Day, right?
It was just after Liberation Day.
That's right. The first reaction was the knee-jerk reaction, get out of stocks and buy bonds.
Right.
And then the vigilantes, or China or Japan or the hedge funds, and the basis trade, doesn't really matter who it is. The fact is that the U.S. is no longer a price maker in debt. It's a price taker, right? And the bond market said, take your treasuries and shove it.
Yep.
So we have a little retracement, so basically a failed breakout, we always see a vicious move in the opposite direction after that happens, right? Or we oftentimes see.
Often. In either direction too. If there was a failed breakdown, the move would be just as vicious to the upside.
Yep, there you go. All right, and so we've broken out of this, and then whenever you break out of one of these price patterns, this is I'm going to call it a triangle.
Okay.
You will get a retest. And then you can actually, I'm not going to do it here, but you can actually use, again, Fibonacci extensions to project a price target. And you can make one of two choices. You can measure at the widest point of the triangle where the sides connect in at least two spots. Or you can be a little bit more conservative if you want to be. And so I think I can do that one more easily.
Okay.
So what we do is we grab our Fibonacci extension. And actually, you know what? Would I use the extension or would I use the retracement on this one? I'd probably use the retracement, right? The extension's beyond the, because what we want to do is measure 100% of this. You know what? Let's do just a shape instead of a, you agree? Instead of a Fibo extension?
Yeah, I mean, I use shapes, but I think it might have actually been an extension, but I like the idea of shape.
Yeah. Well, we can do shape. And so I'm going to do this one. All right. So we'll measure from here to here. And then we'll copy this. Remember how to do that?
That duplicate right there. Third from the top.
Oh, here you go. Yeah, thank you. And then we can add it here. And look at that. Isn't that amazing?
It's a double bottom.
Look at that. Oh, where do you see this? There's the wick of the candle. It made its price target. Look at that.
Yep.
Now we can do a Fibonacci extension for where it could go next. All right. So I'm going to, the breakout price target reached. There's always a throwback retest. And then we can take our Fibo extension drawing.
And it's worth pointing out that this retest is on light volume, which you would expect.
Right. So I'm going to draw from the very peak here. Peak to the nadir. How do you like that word? Ralph Nader. Oh boy, there's a 70s name. And then we're going to do this. So what we're doing is we're basically measuring the flagpole, the flag, and then Fibonacci will give you two price targets, the 61.8, saying the US or the TLT is going to hit around 83. And then if I'm going to have to pull out to a weekly time frame, and I think we'll capture the target. There it is. Yep. Let's see if I can zoom in on it. So this yellow, oops, I blew it. Let's see if I can do that again. So I'll do, I guess we kind of saw it on the 6 month weekly. Will that work? No.
Yeah, probably need to go to a
monthly, maybe
a monthly. Yeah.
All right, it's gonna be really small, but there it is down at that little yellow thing right there,
which is pretty close to a previous low.
79. Yeah, it's a little yellow splotch there. I just don't know how to make this readable on this, so I apologize. But that is the price target, just below 80.
Yep, and I've done the same exercise on the yield itself on the 10-year, and that puts the yield at about 5.5%.
Got it. So that's a 1 point move, right? From here will produce a fairly significant 10% drawdown in treasuries, give or take.
Yeah.
And so somebody might think they're safe in BND. And I had a little bit of an argument with my financial advisor who keeps me from my worst instincts, but I disagree with him on bonds because I see the big collapse in bonds coming soon here. I thought it would be today.
I mean, it's definitely begun.
Yeah. But as soon as we break, and I could do the measured move on this, but here's the important thing. Bonds are a little safer, BND, because it's diversified across more time frames and it's less long end of the curve, more intermediate. I think the average duration on the BND ETF, which a lot of portfolios will have, or they'll have another Vanguard bond fund that's similar. The fact is that for every 1 point move in interest rates, there is about a 5 to 6% decline in the value of the BND. And so stocks might go down, 10% during the same time that the bonds are collapsing, but that's no hedge. Right? To lose 6%, you're in the stuff that you need. Like, and I'm just retiring from my day job. I'll keep doing cheat sheets. And I can't have that. Stocks and bonds going down together is not the playbook.
It's not. No, the 60-40 portfolio is, I think, a relic of the past at this point because the world has changed around it.
That's right. Because the regime is no longer U.S. debt price maker. It's U.S. debt is nobody wants it.
Yeah, and you can't implement and initiate these like big structural policy changes in an inflationary period. It's not bond friendly.
Yep. So I thought that the all I want for Christmas is my two front teeth. Well, you're not getting them. Said Jerome Scrooge, not to be talking Christmas here in April. I should be making a tax day metaphor. But actually Bitcoin, BTC here, held up pretty well. This is the futures contract, but it's all the same. We can look at IBIT. IBIT is what I track in cheat sheets.
Okay.
I'm going to go back to that in a second, but this behaved pretty well considering, both in terms of the 18% drawdown. It kind of went first, right, from its high down here to its low, but it looks like Bitcoin might want to rally, and I could do the same kind of Fibonacci extension here, and I guess I'll do it real quick. Where you, once again, this will be the last thing I do before we wrap up the recording, because I think it's getting long.
Okay. A question, Mike. Do you think that we've seen our oh shit moment?
No.
Okay.
Well, we might have seen the intermediate oh shit moment.
Because my concern for Bitcoin, and I don't know too much about it, my concern is that when that oh shit moment hits,
it's going to collapse with everything else.
Only because there'll be, not only a need, but a demand for liquidity.
Yeah, and so will gold. I think gold will pull back. And that's the history of the bear market of 2007, 2008, 2009. We had gold running up remember when oil was spiking to like 150 bucks?
I do.
This is a long, long time ago. You have to be in your late 40s or older to remember this. But remember, whenever CNBC has their markets in turmoil special, you can usually mark a top or a bottom in something.
Right. It's counter.
So CNBC had their markets in turmoil June 2007, because oil had spiked up to either $125 or $150 a barrel.
It was 148 or 9. It was nearly 150. I think that's what it was.
It did. And gold was running too. So it was basically, again, a weak dollar. Assets expressed in dollars were appreciating against that. And then, very shortly thereafter, both gold and oil topped. And the market, of course, plunged in August 2007, but stocks actually did recover and make one more new high. But that was it for both gold and oil until after the Bear Stearns, I think, was the one that was the first one, right? And then later Lehman.
Mm-hmm.
So between in the summer-ish, maybe early spring 2008, we had our Bear Stearns moment. And then gold started running and didn't stop running from that point on. So Bitcoin is very likely to maybe experience that, but I think there might be there could be it just depends on global liquidity, right?
Right.
And I don't think it's just the U.S. central bank. It can be as stingy as you want, but the EU is going to stimulate. China is going to stimulate. Japan. They're perpetual stimulators. There's going to be a blow up in global M2.
But that stimulation attracts dollars.
Dollar milkshake. I see what you're saying.
Yeah.
But it may attract dollars, but the fact is that eventually the Fed is going to join the party.
Eventually.
Yeah. So the question is, does Bitcoin crash through support and retest this 40-month exponential moving average before it goes higher? Or do we get a little run up, maybe even a double top? But we trade what we see in front of us, and that is that the Bitcoin volume has been deprecating here, and it did act better than stocks. For a volatile asset, much better than stocks during that 2-week Trump tariff tantrum.
Yeah.
And so I would argue that, it's maybe a little less low risk now compared to what it was a few days ago, but having a stop just below here at 72,000, sorry, but we trade IBIT, the ETF. It's still pretty good risk reward if it hits its, even if it just hits its first price target. So I'm actually acquiring Bitcoin through this, and again, there's IBIT. Never lost its long-term trend. It's in an intermediate downtrend. Obviously, you saw that. Buying pressure is not very bullish, but it's no longer anemic. And even the forecast oscillators is starting to give some hope here. So again, right now it's slightly bearish, and Bitcoin's chart is slightly bearish. Right?
Yeah.
So again, it's I think gold is much stronger. And there's other technical ways you could wait to be sure, about a move up in Bitcoin. Oops, sorry about that.
On a percentage basis, gold has outperformed over the last couple of years.
Yeah, and gold is the king, as the
Yeah.
market sniper would say.
Yeah.
And we're right now in an intermediate basis, making a series of lower highs and lower lows, hence the intermediate downtrend.
Yeah.
But a move above this moving average, a move above this, a basing pattern of some kind. You could argue this is a double bottom potentially. So we'll see, right?
Okay.
We'll see. It's certainly better than the NASDAQ.
Yes.
Yeah. And so that'll be the final chart we do, because I think now we're going to be talking to the bears here. And I'll be curious your opinion about, I thought today was technically pretty important. I don't think it was huge volume on the plunge, but it was better volume than it's been. I mean, that is sorry, I kind of drew this. I drew this already. So I basically went more in the last high to the low, pull back, and what's the price target? Well, just so happens to be the first price target is basically the washout low we had last week.
Mm-hmm.
And the second price target is way down here at 380 for the Qs. Remember when we were at 54? We're starting to get some significant potential downside, but I'm going to remove this drawing here, but that's my best guess. And that is, I mean, you cannot say that isn't a good classic bear flag. It's probably better on a weekly time frame. But again, the week's not over, but that is a bear flag. It hasn't broken down yet. And there was a big volume surge here. I think this is an important level.
Absolutely. I think that has to be defended. Otherwise, then, the 380 becomes much more probable.
So remember when you see a cheat sheet chart on Qs, when you see a falling moving average, a red background indicating that there is the likelihood for a multi-month trend to the downside. It's not going to be in a straight line. The one thing is, you notice this whole time the daily 40 EMA line has pretty much maintained yellow. There's been a few splotches of red. So money flow, that's what well, right now I think money flow is actually bearish on the Qs. We'll look at that. But it's the market forecast intermediate oscillator turn neutral plus.
Okay.
And
money flow,
so
shaken money flow is above zero, but it's at
okay. So there it is. And yep. So QQQ. So that's why we're not getting the red, is the buying pressure here, because the intermediate forecast is bearish and price is below a downward trending moving average. But when you have buying pressure holding in there, you're not going to get the red line. Yep. Okay. And I like to have, I mean, so to your point, you're a little, I mean, would you not take this trade because of your worry, or do you just go for what you see? I mean, is it not enough volume in the down move for you to take that bear flag trade? That just looks good. I know. I think the price target is here. Yeah. 407, right? But that's a 40-point move potentially.
Yeah. No, I like that trade.
Yep. So I sold a call spread out of the money up here. Got paid decently. The VIX is still, in the 30s, I think. It's come down. What, about 33 now?
The VIX, it was in the low 30s this afternoon, right? Last look, 32.64.
Yeah, so close enough. There it is. So this is the fear gauge coming down. VIX never stays up above 50 for very long.
No, and I agree with that.
All right, well, I'll publish this video, and I will publish the the one multi-asset class ETF stack in today's blog. But we thought we'd do a video. It's been a while, and this way we can reconnect with you on kind of how to use the tools that we're sharing with you.
Excellent. Thanks, Mike.
And AA is a mortgage specialist. If you're in Colorado,
that's right. That's right.
Call him, and he's going to give you bad news. Probably.
I'm going to tell you there are no 3% rates. Sorry.
Yeah, unfortunately, AA is falling on his sword by being honest about the likely direction of the yield, which ties into mortgage rates.
That's right.
And so he makes his commitment to try to help clients lock at the best rate possible. And he can advise anyone, right? You could I'm sure that there's I know that you've got you and your economist wife, Jenny, have a paid Substack.
Yeah, it's actually, we didn't even turn on the page yet. It's all free.
It's all free. Okay.
Macro Mortgage, yeah.
I guess I'm the only greedy pig.
No.
Well, so hey, do me a favor. If you think these videos are not too self-indulgent and that they help you understand the data that we share with you, mostly for free, I'd love to get a comment from you. If there's anything else you'd like us to do better in these videos, like maybe talk less and stick to the data. I don't think we really did too many morning show dick jokes.
No. It kept the rants to a minimum today.
All right. I'm Mike O'Connor, author of Cheat Sheets, SAA, author of Macro to Mortgage on Substack. We'll talk to you again soon.
See you, Mike.
Bye. Now I got to figure out how to turn this thing off because I'm not used to recording. So just smile and look pretty there for the audience. Because I have no editing capability. I lost my editor subscription. So if you were stop recording functionality, you'd be located. Or stop presenting. This might be a drinking game for those of you sticking with our video.
Here, yeah.
How do you stop? It's called stop recording, asshole.